we're going to talk about cash balance plans, also known as defined benefit plans. Actually, a cash balance plan is a type of defined benefit plan, right? Defined benefit plans are generally thought of as pensions. Think of a cash balance plan, though, as an extra 401k masquerading as a pension. So it has to follow all these pension specific rules, and the costs are a little higher than a typical 401k, but it allows you to max out your 401k, which is this year's, $70,000 a piece, right? Between the employee and employer contributions. If the plan's set up right, you can put $70,000 in there. And if you have a cash balance plan, you can put a whole bunch more money in there. Maybe it's just a little bit, depending on how, the partnership or whatever set it up. Or it might be a lot. I mean, some people are putting $100,000, $200,000, et cetera, into a cash balance plan. The older you get when you start these things, the more you can put in there. In my partnership, you can put as much as $120,000 a year into a cash balance plan once you get to a certain age. And if you're willing to commit to that for 3 years, right? It's got to, the way it's set up like a pension, the funding has to be somewhat stable. For example, when I fell off the mountain last year, I still had to make my payments into the cash balance plan. So we made them from savings for a couple of months when I wasn't working, rather than having come out of my distribution for that month for the partnership. So there are some rules that you have to deal with when you have a cash balance plan. But the benefit is you get way more money into a retirement account, right? Remember, in retirement accounts, your money grows faster because it's not being taxed as it grows. You get that tax protected growth. You also get asset protection, right? This is an ERISA plan. I think I'm pronouncing that right. I was saying ERISA. That was one of the feedbacks we got on our annual survey. Thanks to all of you that filled that out, by the way. But apparently you're supposed to say ERISA. So it's covered by ERISA. So asset protection, right? You have to declare bankruptcy. You get to keep the money that's in the cash balance plan, just like your 401k. Pretty awesome. And then what typically happens with these plans is you close them periodically and open a new one. Right? And you need to have an IRS accepted excuse to do that. But typically, if you've had it open for 5 or most 10 years, you can close it. And what happens when you close it? You roll the money into your 401k. So it's just another 401k. That's what it is in the end. But you've gotten, this pre-tax deduction up front during your peak earnings years. Maybe you get an arbitrage on the back end of that tax rate. You certainly get tax protected growth. You certainly get asset protection. Later down the road, you could do a Roth conversion on this money if you want to. It's just all the benefits of having more of your money in retirement accounts rather than in a taxable account. But there are the complexities of the fact that it has to masquerade as a pension. One of the interesting things about it is a lot of people start wanting to be aggressive in their investments in a cash balance plan. This is not the place to be aggressive, though. Okay. For a couple of reasons. One, if you get really crummy returns, right? Aggressive means you're taking risk, and sometimes the risk shows up. If you're getting crummy returns, you got to make up for them. You got to put additional money in there. That's not the end of the world if you have the money, right? Because you get a deduction for the money you put in too. So it's like you can contribute more that year to the cash balance plan, but you got to come up with the money. And that's a problem in a lot of partnerships. Like in my partnership, that would be a problem. Most of my partners aren't even maxing out their 401k, much less, contributing to the cash balance plan. But, so that's one downside of taking too much risk. The other downside is if you just, smash it out of the park, you have great return year after year after year after year after year. You have this problem if you have too much money in there, right? Because there's a crediting rate that gets assigned to it. It's typically something in the 0 to 6% range. And that's really where you want the returns on the thing to be, is within that range, at least in the long run. Or else you can end up with some excise taxes and all kinds of other issues. But the bottom line is you want to take your risk in the 401k and put, your bonds, your less risky kind of assets in the cash balance plan. So you don't want to be 100% stocks in the cash balance plan. In fact, some people say you don't even want to be 20 or 40% stocks in the cash balance plan. I think ours is 40% stocks in it. But the point is, you're not taking tons of risk. The point of a cash balance plan is to get that big fat tax deduction, get more money into retirement accounts. It's a tax play more than it is an investment play. But you realize that this is only going to be in there for a short period of time, right? If you're closing this thing in 6 years, well, some of that money was only in there for a year or two. right? So, and if you wanted to have some money in bonds anyway, no big deal to have some money in the cash balance plan. Just adjust your 401k to make up for it. No big deal. You manage all your retirement accounts as one big account and have, spread your asset allocation over all the funds that are designated for one goal, in this case, retirement, whether that's a 401k or a Roth IRA, your spouse's accounts, your cash balance plan, your taxable account, whatever, manage it all as one big portfolio, one big asset allocation. Hope that's helpful, helps you understand a cash balance plan. You can open these even as an independent contractor, but it's probably more common to see these opened among partnerships for relatively high income physicians, right? If you're in a cardiologist partnership, it wouldn't be unusual to have a cash balance plan or something like that. If you're an orthopedist or something like that, and you want to be putting away $200,000 or $300,000 for retirement a year, well, this might be a really great piece of that puzzle for you, especially if you're in your 50s or 60s. So look into it. We got some people that can help. If you go to whitecoatinvestor.com, you go to our recommended page, go down to retirement plans. We got a whole list of people that can help you set up these sorts of things.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.